If you've ever actually tried to backtest an option strategy, you know exactly how painful it can be, right? We're talking endlessly tedious spreadsheets, absurdly expensive historical data feeds, and just hours of mind-numbing manual entry, all just to see if a simple idea actually works in the real world. But what if you could transform that exhausting process into a fully automated dynamic experience? Well, welcome to this explainer. Today, we're tearing apart a seriously fascinating open-source Python and Streamlit project that basically takes all the heavy lifting out of systematic options backtesting. We're going to decode the engine behind it and show you exactly how it simulates real-world trading, and here's the kicker, it does it without needing those massive, expensive institutional data feeds.
So, here is our roadmap for today's explainer. Number 1, systematic options strategy testing. Number 2, the entry and exit rules. Number 3, pricing and volatility mechanics. Number 4, managing capital and positions. And finally, number 5, the analytics dashboard. Let's jump right in.
All right, Section 1, systematic options strategy testing, automating the credit spread.
Before we get into the heavy code logic, we really need to establish our baseline. This entire backtester is engineered around one highly popular option setup, the bull-put spread. Basically, this is a bullish strategy where you sell a put option to collect premium and then simultaneously buy another put option further out of the money at a lower strike price. Why do we do that? Well, it creates a net credit up front and strictly caps your maximum potential loss. It's a fundamental income strategy, and this engine totally automates evaluating it over decades of market data.
Moving right along to Section 2, the entry and exit rules, the brain of the backtester.
Okay, let's really dive into this. This engine doesn't just randomly guess when to enter a trade. It relies on a super strict 4-part moving average condition that's hunting for the absolute perfect pullback. So, first, the entry price has to dip below the fast 21-period moving average. Second, that price must still remain above the slower 50-period average. Third, the 21 period must be trending above the 50 period. And finally, the 50 period must be above the 100 period. Simply put, the engine mathematically confirms a long-term uptrend and then just waits to pounce on a short-term dip. Oh, and to prevent overtrading, it only fires on the very first day this exact mathematical condition is met.
But, as any trader will tell you, getting into a trade is only half the battle. How you exit is what actually determines your long-term survival. The backtester handles exits brilliantly by evaluating multiple scenarios all at the same time, closing the trade the exact moment any single one of these conditions triggers. So you can exit for a win when 50% of the maximum profit is captured, which is a very classic options trading benchmark. Alternatively, a time stop kicks in, defaulting to 7 days to expiry, mostly to prevent gamma risk, those wild, unpredictable price swings that happen right before an option expires. For downside protection, you can close the trade if the underlying price breaks below the 200-period moving average, or you can even implement a hard stop loss set at a multiple of your initial credit received. This really shows how the engine prioritizes capital preservation and locks in gains dynamically.
Okay, on to Section 3, pricing and volatility mechanics, the gears under the hood.
We have reached what I personally consider the most impressive part of this whole project. If you've ever looked into options backtesting, you know historical data is notoriously massive, fragmented, and frankly, incredibly expensive. So here is the million-dollar question. How exactly does this lightweight Python script accurately price historical options over a 20-year period without relying on gigabytes of premium tick data?
The answer is just elegant math. Instead of looking up historical quotes in some pricey database, the engine dynamically synthesizes the spread using the Black-Scholes model. Let's break that down. First, it targets a specific options delta, which is essentially the probability of the option expiring in the money. By default, that's set to 0.40. Second, the script runs a binary search algorithm to mathematically hunt down the exact strike price corresponding to that delta on any given historical date. Third, it just subtracts your configured spread width to find the long put strike. And finally, it calculates the theoretical price of both legs to establish your net credit. It literally generates the pricing data on the fly. It's so smart.
Now, to make that Black-Scholes formula work, you absolutely need a highly accurate volatility input. And this is where the engine takes a really clever two-pronged approach. First, whenever possible, it pulls real CBOE volatility indices, like the VIX for the S&P 500 or OVX for oil, which ensures institutional-grade accuracy. But what if you want to backtest some random tech stock? Well, the engine brilliantly falls back to a custom-blended, exponentially weighted moving average. It basically mixes historical volatility across 10, 21, and 30-day periods and then floors it at the VIX.
This ensures you get realistic pricing no matter what ticker you throw it.
Section 4. Managing capital and positions. Realism in compounded.
An options backtester is basically useless if you can't tailor it to your exact trading style, right? Well, because this is built on Streamlit, it features a highly customizable sidebar that gives you total control. You can dictate the target tickers, you can even run two simultaneously like SPY and QQQ, you can set the target days to expiry, tweak your delta, and crucially, account for trading friction by setting precise commission rates. This takes the backtest from some theoretical vacuum right into the gritty reality of a retail brokerage account.
Let's talk about the money. The engine defaults to a starting capital of $10,000. Why does this matter? Because the application doesn't just casually list trades, it tracks your entire account value on a daily mark-to-market basis. That means it calculates your unrealized profit and loss from open positions right alongside your closed cash balance. It literally simulates the exact experience of logging into your brokerage account every single day, year after year.
And of course, managing capital means managing risk. 50%. That is the default capital deployed limit here. See, the engine utilizes fully dynamic position sizing, meaning the number of contracts you trade naturally scales up as your account equity grows. However, to prevent a single black swan event from completely wiping you out, the engine ensures the maximum possible loss across your entire portfolio never exceeds half of your total current account value. It literally forces strict risk management upon the strategy.
Finally, Section 5, the Analytics Dashboard, visualizing the results.
So once the engine has chewed through decades of data, it needs to present the findings. The absolute centerpiece of the Streamlit interface is this massive, interactive, TradingView-style candlestick chart. You aren't just staring at boring rows of data, you can literally zoom in, scroll back in time, and visually verify the logic for yourself. You can see the moving average overlays, pinpoint the exact entry and exit markers drawn right on the candles, and use a live crosshair legend to inspect the prices. It gives you incredible visual confidence that the code is doing exactly what the strategy says it should do.
Right alongside that chart, the dashboard generates a comprehensive suite of key performance indicators. You get your compound annual growth rate to see your yearly return, and the Sharpe ratio to actually understand your risk-adjusted performance. It highlights your maximum drawdown, which is the absolute pain your portfolio would have suffered from peak to trough. It tracks your win rate, and incredibly importantly, it plots a normalized buy and hold comparison. So you can instantly see if all this active options trading actually managed to beat simply holding the stock over the exact same period.
But I think one of the most powerful insights the dashboard generates is a detailed breakdown of precisely why your trades exited. Were you constantly hitting your 50% max profit target, or were you getting dragged out by that 7-day time stop? Are your hard stop losses triggering a bit too frequently? Understanding exactly which rules are driving your portfolio's turnover is the absolute key to fine-tuning your parameters and truly optimizing performance.
By automating the complex math of Black-Scholes pricing and combining it with really strict dynamic risk management in such an accessible interface, this backtester fundamentally changes the way we can evaluate option strategies. We've stripped back the moving average signals, the volatility fallback systems, and the dynamic position sizing that makes compounding so realistic. So I'll leave you with this thought. With all of these institutional-grade mechanics fully accessible right at your fingertips, which tickers are you going to test first?